Forecasting financial performance is integral to a variety of business decisions, ranging from investing to managing a company effectively. We might, for example, wish to value a company's common stock before purchasing its shares. Or we might be interested in evaluating the creditworthiness of a prospective borrower. We might also be interested in evaluating alternative strategic investment decisions. All of these decisions require accurate financial forecasts. In this and the next video, we'll discuss the most common methods used for forecasting income statement. Although an accurate forecast requires forecasting all of the financial statements, but during this semester we'll only focus on forecasting the income statement. The forecasting process begins with the retrospective analysis. That is, we analyze current and prior year statements to be sure that they accurately reflect the company's financial condition and performance. If we believe that they do not, we adjust those statements to reflect the company's net operating assets and the operating income that we expect to persist into the future. We already performed this retrospective analysis during the step 3 of the project. All forecasts are based on a set of forecasting assumptions. For example, to forecast the income statement, we must make assumptions about revenue growth and other assumptions about how expenses will change in relation to changes in revenues. The old saying, garbage in, garbage out, is apt. That is, the quality of our decision is only as good as the quality of the information on which it is based. We must be sure that our forecasting assumptions are consistent with our beliefs and predictions for the future growth and do not reflect any of our personal biases. Forecasting revenues or sales is arguably the most important step in the forecasting process, as expense items like cost of goods sold and operating expenses are typically forecasted as a percentage of forecasted revenues. There are many ways for forecasting income statement, but the percentage of revenues approach, the one that we are going to use this semester, is the simplest to implement and is the one that is widely used by analysts. Finally, the steps for forecasting income statement begins with a forecast of revenues. As already discussed, this is a very important step, and I have created a separate video to help you understand the forecasting of revenues. In the next step, we forecast the operating expenses using the common size approach. That is, we assume a relation between revenue and each specific operating expense account. Forecast of non-operating expense such as interest income or interest expense is based on certain asset or liability accounts on the balance sheet. For example, in order to forecast interest income, we first need to forecast total assets, and then we forecast the cash balance using the common size approach, and finally, using historical interest rate earned on the average cash balance, we forecast the interest income. Similarly, interest expense is forecasted using the forecast for interest-bearing debt. Tax expense is forecasted as a percentage of earnings before tax. In the next video, we will forecast the income statement for Walmart.